Ever heard of ETFs but have no idea how to actually start investing in them? You're not alone. Questions like, how do I even begin? Which account should I use? And how do I set up a savings plan without messing it up are super common. Well, this video is your answer. We're going to walk through how to start investing in ETFs step by step. It'll be clear, neutral, and practical. By the end, you'll know exactly what you need to do to start building long-term wealth through the stock market. First things first, you need a brokerage account. Think of it like a digital vault for your investments. It's similar to your checking account, but instead of holding cash, it holds your ETFs and other securities. Through this account, you can buy and sell ETFs, check your portfolio, and receive dividends. You'll usually access it through a mobile app or a website, just like online banking. In the US, you've got three main choices. First, traditional banks like Wells Fargo or Chase, they offer personal service but often come with higher fees. Second, there are online brokers like Fidelity or Charles Schwab. They're a great middle ground, offering low costs, a wide range of ETFs, and solid customer support. For most people, this is the sweet spot. Third, you have app-based brokers or neo-brokers like Robinhood or Webull. They are mobile first, super user-friendly, and have very low costs, making them perfect for beginners who want to get started quickly. So, which one is right for you? If you prioritize low fees and a simple experience, a neo-broker is a great choice. If you want more research, tools, and customer service, a full-featured online broker might be better. The most important things to look for are no account maintenance fees, low or zero trading commissions, and a wide selection of ETFs. Opening an account is quick, usually just 10 to 15 minutes online. You'll verify your identity, and no, this won't affect your credit score. Once your account is open, you can transfer money from your bank and you're all set for your first purchase. Okay, your account is ready. Now for the big question. Which ETF should you buy? An ETF or exchange-traded fund tracks a market index like the S&P 500 or the MSCI World. This means by buying just one ETF, you're instantly investing in hundreds or even thousands of companies from all over the globe without having to pick individual stocks. For instance, an ETF tracking the MSCI World Index gives you a piece of about 1,500 companies in 23 developed countries, from Apple and Microsoft to Nestle and Toyota. You're basically investing in the global economy as a whole. When you're choosing an ETF, there are a few key things to look for. First, diversification. You want a fund that invests globally across different sectors and regions. Broad indexes like the MSCI World or FTSE All World are fantastic for beginners. Second, check the costs. The annual fee, called the TER or expense ratio, should be low, ideally between 0.05% and 0.30%. These fees are automatically taken from the fund's value, so you barely notice them. Third, Think about the replication method. Physically replicated ETFs actually buy the stocks in the index, which is straightforward and easy to understand. That's usually the best bet for beginners. Fourth, decide on the dividend policy. Accumulating ETFs automatically reinvest your dividends, which is great for long-term growth thanks to the power of compounding. Distributing ETFs, on the other hand, pay the dividends directly into your account. For most long-term investors, accumulating is the way to go. You can also consider sustainability. If you care about environmental or social issues, look for ESG or CI ETFs. They exclude industries like weapons, tobacco, or fossil fuels. Finally, stick with large, reputable providers like iShares, Vanguard, or Schwab. They manage billions and are very stable. Some solid examples for beginners include the iShares Core MSCI World ETF for developed markets, the Vanguard, FTSE All World ETF, which includes emerging markets, or the SPDRS and P500 ETF. If you want to focus on the US market, honestly, don't get stuck trying to pick the absolute perfect one. The most important step is just to start. Once you've picked your ETF, it's time to make your first purchase. It's really simple. Just search for the ETF's ticker symbol, or ISIN, in your broker app, something like VTI, or a long string of numbers and letters, and tap Buy. Enter the amount you want to invest, maybe $500 or $1,000, and confirm the trade. Most brokers charge little to nothing for this. The money will be taken from your account, and voila, the ETF shares will appear in your portfolio. Here, as a pro tip, try to place your trade on a weekday between 10 a.m. and 4 p.m. Eastern Time. That's when markets in both the US and Europe are open, and you'll generally get the fairest prices. After you buy, don't panic if the price goes up and down. Markets move every day. That's completely normal. ETFs are for the long haul, think 10, 20, or even 30 years. So resist the urge to check your app every day. Focus on consistency, not short-term blips. Now, for the secret weapon of long-term investors, the ETF savings plan or automatic investment plan. This is the easiest way to build wealth over time. You simply invest a fixed amount automatically every single month. This strategy has huge advantages. First, it takes the stress out of trying to time the market. You invest regularly, whether the market is up or down, which allows you to benefit from something called dollar cost averaging. Second, it builds automatic discipline. The plan runs on its own, so you don't have to keep making the decision to invest. And third, it unleashes the magic of compounding. Your regular contributions will create exponential growth over the decades. Setting it up is a breeze. In your broker's app, look for an option like recurring investment or auto-invest. Pick your ETF, enter your monthly amounts, $100, and choose which day of the month you want the money to be invested. Most brokers can pull the funds directly from your checking account. Once it's set, you can just forget about it. A good rule of thumb is to invest 10 to 20% of your monthly income, but even $25 or $50 a month is a fantastic start. The key is to build the habit. Let's quickly touch on taxes. In the US, you'll pay capital gains tax when you sell an ETF for a profit, and you'll be taxed on any dividends you receive. But the good news is that ETFs are very tax efficient, especially compared to many mutual funds. You only pay taxes when you actually sell for a gain or get a dividend payout. And if you hold your shares for more than a year, you'll pay a lower long-term capital gains tax rate. Better yet, if you invest through a tax-advantaged account like a Roth IRA or a 401k, you can avoid or defer taxes completely. So, taxes are definitely not a reason to avoid investing. They're manageable and, with the right account, often minimal. Now, let's talk about some common mistakes to avoid, because these are what trip up most beginners. First, don't buy too many ETFs. One or two globally diversified funds are usually all you need. Simplicity is your friend. Second, don't check your portfolio constantly. This just leads to emotional decisions. Look at it a few times a year, at most. Third, stop trying to time the market. Nobody can consistently predict short-term market moves. Regular automated investing will beat perfect timing almost every time. Fourth, and this is a big one, don't sell in a panic. Market drops are temporary. The key is to stay invested and ride out the bumps. And finally, watch out for high fees. Avoid complex, actively managed funds or high-commission products that some banks might push. The best ETF strategy is simple: low costs, high discipline, and a whole lot of patience. Investing is as much about your mindset as it is about the numbers. The biggest challenge isn't a volatile market, it's your own emotions. The best way to manage them is to create a routine. Invest automatically every month, treat it like any other fixed expense, and forget about it. So, let's recap the whole process into 4 simple steps. 1. Open a brokerage account with an online or app-based brokerage, free and easy. 2. Choose a broad, low-cost ETF, preferably an accumulating one. 3. Make your first one-time investment. Even $500 is a great way to get started. And 4. Set up an automatic monthly investment plan, starting with as little as $25. After that, just stay consistent. Remember, successful ETF investing isn't about timing the market, it's about time in the market. So, what's next? In our next video, we're going to dive into your brokerage app and demystify all those confusing terms. What do limit order, exchange, and bid-ask spread actually mean? And how can you learn to read ETF charts like a pro? If you want to get more confident with your investing tools, make sure you stay tuned for part 2. I really hope this video was helpful for you. If it was, please give it a thumbs up. I'd also love it if you'd subscribe to the channel. That way, you'll get regular videos and tutorials on investing that make the world of finance easier to understand. Thanks so much for watching, and I'll see you in the next video.